Good morning, everyone. I hope all is good so far. Let's quickly go through inventory, IAS 2. This standard is very much important. And yes, you still have to know the basics from the undergraduate or maybe from the first year or second year. Obviously, you need to understand that inventory is part of the financial statements, and inventory is recorded under the current assets in the statement of a financial position. And remember that for you to have inventory, you need to make sure that you capitalize all the costs which have been incurred in the process of bringing that inventory to the place of business. So all those costs incurred in the bringing of that particular inventory need to be incorporated. Okay, so you need to make sure that you know which cost to capitalize and which cost to exclude. Okay, so I'm going to go through that very quickly. Now, firstly, let's talk about, okay, this is my details, guys. Okay, no problem. Let's go to the standard. Obviously, here, our main objective is to calculate the cost of inventory. And thereafter, normally when we determine the cost of inventory, the initial recognition is always at a cost. Okay, but subsequently, we need to make sure that we recognize the inventory using the lower of the cost and the net realizable value. Okay, but remember, initially we recognize at a cost, and subsequently we need to make sure that we check the lower of the cost of that inventory and any net realizable value. So, and then again, you need to know how to calculate the cost. As I said, all the costs which have been incurred in the process of bringing that particular stock or inventory to the place of business. And again, I'm going to show you how to calculate the net realizable value. So again, we need to know how to account for that. Okay. We need to know the cost formulas. Obviously, sometimes we do use what we call the FIFO and the weighted average method. We used to have LIFO before, but LIFO we don't use it anymore. So we're just going to use FIFO and which is first in, first out, and the weighted average method. Okay. Just a definition, as I said, you need to understand the basics around inventory. As you can see, the inventory is held for sale in the ordinary course of the business, in the process of production for such sales, and to be consumed in the production of goods and services. Like you know from your previous studies, you need to understand the main aim of the business, the reason why we are in business, so that you can be able to know which items are inventory and which ones are PPE at the end of the day. Okay, you need to understand that inventory is what we hold in the business to resell to make profit. Are we together? So, but if let's say, for example, you are a car dealer, the cars which you are selling will be classified as inventory, but the cars which you are using maybe to transport your customers to their place of work, that car cannot be classified as inventory. It will be classified as the property, plant, and equipment, also known as the PPE. Okay. This is just a sneak preview of what will the cost consist of. As you can see here, cost consists of all the costs incurred in the process of bringing that particular asset to the place of business. And again, if you are in a production process, obviously remember you need to incur those manufacturing costs. In a nutshell, we've got the direct material, the direct labor, and the manufacturing overheads. Those costs need to be incorporated in the production of that particular product. So that's why I say material, labor, manufacturing overheads, as you know, are those costs which are incurred in the process of further processing that particular product. They are the indirect material, the indirect labor, and other overheads. Okay, as long as they're incurred in the process of manufacturing. And remember, those manufacturing overheads at the end of the day are based on the normal output. It means they are based on the normal capacity. So you see, by the time when we deal specifically with the fixed overheads, we need to allocate them according to normal capacity. Okay, because sometimes they give you the extra in the normal, you need to use the normal capacity. All the transport costs which have been incurred in the process of transporting that particular product that we bought need to be incorporated. And sometimes we do pay what we call the irrecoverable taxes. It can be the import taxes, it can be any VAT, it can be any cost that is related or any tax that has been paid in the process of bringing that particular product. We need to make sure that we incorporate them because they are not claimable. Irrecoverable means you cannot claim this. They are not refundable. So as long as they are not refundable, for example, VAT is not refundable, it will be part of what? Of the cost. But if it is refundable, it's going to be excluded. And again, you need to know that any normal spoilage or any normal wastage needs to be part of the cost, but not the abnormal postage. So at the end of the day, we need to make sure that we know which cost to consider. Okay. And at the same time, we need to know how to calculate the net realizable value. We need to know the selling price, any less any cost to complete that product, a particular product, meaning maybe it is to be processed further, any cost of selling, and thereafter that will be the selling price. So and thereafter the lower of the two is going to be the amount that we're going to use to recognize the asset in the books of account. Okay, please for more information, make sure that you go and consult the standard and make sure that you use the IAS 2 for that. Okay. We specifically exclude any abnormal spoilage or costs, any storage costs. In other words, these are like after costs in a way, after production costs. So any commercial costs in the form of administrative costs and the selling expenses. Okay, these are some of the examples, but you can find more costs which need to be excluded. So please make sure that you go and learn more about those costs. The techniques, the methods from to measure all the costs, sometimes use standard costing. Remember, standard costing is very much important. So you can either use standard costing where we use those variances. Remember the material price variances, the material quantity variances, the material mix, all those variances can be used in order to calculate the cost of our inventory. And we can use the retail method. Remember when we used to do the markups where you have to mark up the cost, markup in on selling price. Sometimes they say the markup is on cost. So you must know how to use the markups in order for you to be able to calculate the cost. Okay. As I said, sometimes we can use FIFO, sometimes we use weighted average method, but the question will tell you which method to use. But remember, the entity must use the same cost formula inventory with similar nature and use. This is very much important. Okay. Now, without wasting time, I just want us to make sure that we we make sure that we analyze the question, and thereafter we need to make sure that we understand which cost to use at the end of the day. Now, let's analyze the information which is given to us. Firstly, we need to highlight that the fact that we know our business is Sylvester Ltd and 31st. This is very much important. This is our current year, 31st of December. And they gave us the following inventory, the inventory. This is the inventory that we've been given. As you can see here, we've got the raw material, we've got the work in progress, we've got the finished goods. So these figures are for the end of the current year, and this is 2018 is the previous year. So this is the stock given to us at the end and at the beginning. The following took place during the current year, which is 2019. They've written down the inventory at an amount of 334. Remember when we started there, we said the written down values will be part of the calculation of the cost of inventory. We also had a reversal during the period. The reversal of the written down, the reversal here of the written down is how much? It's 94,600. Remember, the reversal is just the complete opposite of the written down amount. So here I can see that we are gonna invest something, and they say the reason for reversal is because of the absolute inventory which was reintroduced to the market. Okay, that is the reason for the reversal. So they gave us information about the raw material and the work in progress. During the current year, the raw material of 1,320,000 was bought and discount of 10% has been given to us as a business. Okay, remember we're just analyzing now. And in that process, we also incurred the transport cost. Remember, this transport cost has been incurred in the process of buying that particular raw material. It means we need to add it to the cost of stock. We also incurred the import duties of how much? Of 4,180. Again, the import duties have been incurred in the process of bringing the inventory to the place of business. Again, I can foresee that we're going to add it to the cost of inventory. Okay. The work in progress, you can even call it the production account. Okay, the work in progress, we incurred labor of 30 rand per hour. At the beginning of the production, there has been a normal spoilage of how much? Of 3%. Okay. The production capacity and the normal capacity were 9,515 hours, and then 7,975 respectively. In other words, these are the production capacity and the normal capacity. And we had the idle hours of how much? 1,650, of which 220 were due to unplanned strike. In other words, remember that the normal idle hours need to be part of the hours worked, but we need to deduct the 220 thereafter so that we can arrive at the correct figure. We also have the variable cost of 40 rands per unit. Remember, for now, we're just analyzing. Okay. The total fixed costs were allocated according to what? The fixed costs were allocated according to the production units. And then the total actual fixed costs were how much? 1,650. Remember, we said the fixed costs are using the normal output or the normal production units. So the normal production units were how much? Were 88,000, and the actual units were how much? 82,500. So now we have all the information. We are ready to go and record in the books of accounts. Okay. I hope everyone is following at the moment. So please make sure that you go through the standards to make sure that you know how to account for these things. Okay, thank you. Now it's time for us to record the information. Remember, under the normal process of manufacturing, if you remember very well, especially under the cost accounting or the cost and management accounting, remember, under the production process, we need to buy the material, and that obviously the material consists of the direct material and the indirect material. And that material needs to be converted into a final product. So the conversion process is where we apply our labor and our manufacturing overhead. So the manufacturing overheads and our labor are normally called the conversion costs because they convert raw material into finished goods. So we've got the raw material, we've got the production process, which is represented by the work in progress, and thereafter we've got the finished goods, which are ready for sale to the consumers. So the finished goods will lead us to what we call the cost of sales. That's why it is very much important to know the flow in the manufacturing process. Because even here, we're going to follow that particular flow. Okay. Firstly, we need to go and buy the raw material. And firstly, as you can see, we have got the balance given to us at the beginning. So the first thing that we must put, we put the balance at the beginning, 2018 for 880,000. But during the period, we did buy this, remember, raw material. We bought the raw material for how much? For 1,320,000. But remember, when we bought, we were given a discount of how much? Of 10%. We need to deduct that discount because we only incurred an amount that is less than what? The original amount. So the discount is 10%, which is 132,000, and we less it. So if you want, you can even have, say there, add net purchases, and you can minus this 132 in brackets here. It's up to you at the end of the day. Okay. And again, in the process of buying that material, remember we incurred the additional cost. Remember the transport cost, they need to be included. Okay. We also incurred what? The import duties of how much? Of 418. Okay. Remember the normal spoilage must always be part of the calculation. You must not deduct any normal wastage. Okay. So you need to leave it like that. It is part of the process. Do not deduct the spoilage. Okay. Now, thereafter, we need to minus the closing stock that has been given to us. As you can see from the question, we need to minus 2,696. And the amount that we get is the one that is going to be transferred to the work in progress. Remember, the work in progress is like the production account. So like I said, under cost management accounting, we had to deal with this account. I remember we had to open the raw material account where we have to make sure that we account the information the same way we accounted here. This just in a statement way, but they can ask you to have this in an account way where we have both the debit side and the credit side. Obviously, the raw material is inventory, the balance at the beginning will be on the debit side. When you buy, you must increase on the debit side. When you transfer to the production, obviously you must go to the credit side. So it's the same as the account. It's just that here we're using it in a statement. Secondly, we need to go to the work in progress. Firstly, again, we need to make sure that we take the transfer. We said the transfer to work in progress. So you must go and transfer that raw material to the work in progress. Can you see the amount are the same? Okay, so we need to make sure that we know how to relate the two. So this total has been transferred to the work in progress. And then if you can check the information about the work in progress, we did incur the labor cost, but firstly we've got the balance at the beginning, like we did under the inventory. We need to put that balance at the beginning, okay? And thereafter, we need to add the labor that we incurred. Remember the hours, if you can go back to the information there, they say we had incurred the production capacity and the normal capacity are 9,515 hours and 7,975 respectively. So here we need the normal hours. So the normal hours were 7,975. And remember, you must add the idle hours and deduct the unplanned idle hours, okay, due to strike. Can you see? So you must take the normal hours plus the idle hours minus the unplanned strike hours, and thereafter you multiply them by the labor cost that they give. Can you see? The labor cost which was incurred was 30 rand per hour. So after doing that, we get 282,150. And remember, we did incur the fixed cost, and those fixed costs were what? Were the actual fixed cost. Remember, we need to allocate using what? The normal production output. So the normal production output, if you can check there, they are how much? 88. What we need to do, we're going to take the actual of 1,650, divide by what? By 88,000, which is the normal production hours. And thereafter, multiply by the actual the production. Can you see? These are the actual units produced. So you need to take the fixed cost, you divide by the normal production units, and you times by the actual production units. And you're going to get what? 1546875. Okay. Remember, we also incurred the variable cost. According to our information, the variable cost was 40 rand per unit. So you're just going to take the 82,500, the actual production units, and you multiply them by 40, and we get 3.3 million. And thereafter, we just have to less your closing inventory, and you get a total of 6582270, which must be transferred to the finished good. Remember, this is just a process. From the raw material, we go to the work in progress. From the work in progress, we go to the finished goods. The same procedure, because we said transfer to the finished goods, we must first put the amount that came from the finished goods. Can you see that? And thereafter, the same procedure. Do we have anything at the beginning? Yes, we must first put the opening balance like we did under the raw material and the work in progress. And thereafter, we need 2 less the written down value of how much? Remember, 334. We have the written down value to what? Net realizable value. And thereafter, we had to add back the one that we reversed. Okay. So you need to make sure that you know that the return amount must always be deducted because we wrote, or in other words, we decreased that cost of the finished goods by how much? 334, because just written down to the net realizable value. In other words, the cost was more than what? The net realizable value. So that's how we have to deduct. But this one has been reversed, we need to add back. Okay. Thereafter, you must deduct the opening and the closing stock, as you can see from 2019 of 2695, and thereafter you get 429155. That is the cost of goods sold. Okay, and thereafter, this, remember, our main aim is to calculate the inventory to be recognized as an expense. So after finding the cost of goods sold, you need to go and make sure that when you calculate the total expense to be included in the profit and loss, you will first have the cost of goods sold, and thereafter you need to add any fixed overheads that is under recovery. So if you've got the over recovery, you need to make sure that you less. Remember, the under and the over recovery, we normally deal with this under management accounting, where we compare our actual fixed costs together with the budgeted cost. Okay, so at the end of the day, if you can check, we had 1650. This 1650 was the actual fixed overhead, and then now we must deduct what? 1546875. This is the overhead. Remember, if you can go back here, we've got the fixed costs which we applied here. So these are the applied fixed overheads. These are what? Actual. Let's compare the actual fixed overheads and the applied one. So what we do, we had the under recovery. We need to add. Okay, if it was over recovery, it means we're supposed to deduct. Okay, what you call the fixed expenditure overhead variance. Okay, if you remember very well. And thereafter, the written down value that we had here. Remember that written down value expense. So at the end of the day, it must come, and we need to add it to our calculation of the inventory expense. And the one that we reversed, now we need to what? To deduct. Okay. And thereafter, you will get an amount of 487208. An expense that is going to be part of the cost of sales. So the total expense that will affect the profit and loss. So this is a very simple thing. As long as you must be careful for you to be able to know which figures will affect each account. Again, the process, the raw material, and you go to the work in progress, and thereafter you go to the finished goods, and after the finished goods is then that you calculate the inventory to be recognized as an expense. This will affect the profit and loss. Remember, we said as an expense. I didn't say an inventory to be recognized in the statement of financial position. Okay, so if they asked us for the inventory to be recognized in the statement of financial position, is where we're supposed to compare the cost and the net realizable value. And the lower of the two was supposed to be disclosed under what? The statement of financial position. Here we're talking about the inventory expense, which will be part of the cost in the statement of profit and loss and other comprehensive income. You need to read the question carefully at the end of the day. I'm looking for the expense. I'm not looking for an inventory as an asset. I repeat, if I'm looking for inventory as an asset, I was supposed to compare the cost of that inventory together with the net realizable value and take the lower of that. Okay, so in the near future, I'm going to take a question based on that so that you can know how to account inventory in the statement of financial position. It is very much important, guys, to make sure that we understand. You can score more marks on this one. It can be a little bit advanced, but as I said before, it is important for us to start with things which are simple to understand before we can apply them in those advanced situations. So I think this short video will give you an idea of what does IAS 2 apply to. Okay, so it applies to the inventory which we are going to sell to the customers in order to make what profit. And remember, the inventory that we are selling at the end of the day normally affects the profit that we make, and obviously at the end of the day it will affect our financial position. That's why we need to know which figures will affect the profit, meaning which figures will affect the statement of profit and loss, and which figures will affect the statement of financial what position. I hope that this video is good to you. So at the end of the day, let's make sure that we understand better, guys. Thank you very much, guys. I wish you all the best. Hopefully it makes sense. If it doesn't make sense, guys, please try other avenues. You can even go back to the book and check more, but you are welcome to ask questions if you want. Okay, thank you very much for listening. Have a great one. Thank you.